Hi there. Now it's time to start speaking of hedging because we have seen so far and in very detailed manner everything related to speculation, and now it's time to speak of hedging. So first of all, hedge means protection. To be hedged means to be protected. So before going into economics, let's see how we do hedge ourselves in our daily life. How do we hedge? Let's suppose that we forecast the weather to change with heavy rains. So when we speak of that, the event would be the rain. The risk would be getting wet. The consequence of the risk would be catch a cold. And the further consequences would be to get ill, not to be able to go to work, not to be able to enjoy a period of our life. So what do we do to avoid that risk? We hedge, we protect ourselves with a tool. The tool in this example is an umbrella. You carry an umbrella, the umbrella would be your hedge, okay? And that would mean the same thing in our daily life. For example, if you're planning to go on holiday to Europe, the currency is the euro, while your currency is not the euro. So you are facing a risk, and think of the dollar, how much is bouncing up during those days. So suppose that you are planning to go on holiday to Europe, and the currency is the euro. It's not your currency. And the risk is the euro going up, going up against the rupee, correct? So how do I protect myself? Well, I take some rupees, buy some euros. The next month with my salary, I take more rupees, buy more euros. But again, from day to day, if the euro keeps going higher and higher, perhaps you won't be able to make the trip. So what if you have the opportunity to buy euros against the rupees at the futures market, which means you fix a contract with the bank for a future date, let's say for end of September, that by the end of September, you're gonna come with 100 rupees, and the bank is going to give you, it's an example, 100 euros, okay? Sorry, you're going to come with 10,000 rupees, and the bank is going to give you 100 euros. I'm using an exchange of 100 to 1, okay? There, if you do that, there's no more risk. You are hedged. From there on, you have the right to get your 100 euros, and you're going to have the obligation to deliver against that a 10,000 rupees. Okay, it's 100 times 100. Okay, that's it, and that is your hedge, which helps you to protect the risk you're running. So the hedge is an action you take in the futures market to protect yourself against a certain risk that, with this example, means to be able to buy the currency you need for a trip. So let's now go into your business. Let's go to the simplest example. Let's suppose that you export, okay? And you get your payment in US dollars. Of course, if the US dollar goes higher and higher every day against the rupee, it's fantastic because you're gonna get more and more rupees because the rupee keeps being devaluated. But what if the opposite happens? So if you don't want to run such a risk, you need to establish a hedge, which in this example will be at the futures market to sell a certain quantity of dollars that you are exporting to cover your expenses. And you sell the dollars by rupee. That's your hedge against the fluctuation of the currency. So finally, as a simple example, when you want to protect yourself as a hedge, and let's suppose that you are buying zinc at the domestic market, buying aluminum at the domestic market, you buy it, okay? And you pay a price of $2,500. And let's suppose that your idea is to transform it and to sell it as a alloy, yeah, as an alloy. You put it, you're a secondary foundry. So you buy it at a fixed price and you transform it into a different product that still contains aluminum. If the price of the aluminum in the futures market goes down, you have a problem because you have already paid for the aluminum, but you didn't sell it so far. So you need to hedge it selling in the futures market. And this is just the beginning. See you next week.